The review of the rate of return determination allows us, consumers, to present a consumer-centred approach to the funding and governance of the energy commons. The Australian Energy Regulator has presented the investor-centred approach. In this talk, I start with the evolution of money and a variation to automate sharing capital at the time of transactions occurring. Automation reduces the cost of working together so investors and consumers can address the existential challenge of climate change. The discussion is not about the cost of energy, but about how we can best use the resources we have to assist future generations in surviving on this planet. I will briefly discuss the social evolution of money, a way to bring choice to capital markets with another form of capital, a recommendation to the Australian Energy Regulator, and finally, the broader social impacts and how this form of capital can accelerate and fund the rewiring of Australia. Humans have become the dominant species because we learned how to work together through gift-giving things of value. Most personal transactions with family, friends, colleagues, and workmates still use social tools based on sharing. Money is an invention that allowed us to automate the accounting for sharing value. Unfortunately, the common ways to exchange new capital is that capital is not shared. Capital is created when we make a profit from the exchange of money and goods. Investors keep all the capital, the new capital, and do not share it with consumers. Our social system has evolved expensive processes to adjust the system to share. The free market is an expensive way to give sharing with lower prices. Taxes used to redistribute income are another expensive way to redistribute new capital. Loans are yet another expensive way to allow others to share profits. One way to increase productivity is to share new capital during a transaction that creates the new capital. By sharing the capital under predefined rules, it becomes more productive because the cost to create and share capital is near zero. In modern, large, capital-intensive systems, the cost of not sharing is more than the cost of the asset. Hence, sharing allows us to double the productivity of capital or get twice as much investment from the same amount of capital over a period of time. In the energy market, there are two dominant forms of capital, loans and equity. Another is now consumer capital. With consumer capital, investors invest to get a share of the profits. They do this by buying an income stream from the capital. While they own the capital, they get a fixed amount from the profits. With equity, they would get all the profits. When the regulator sets the rate of return, the consumer investors know exactly how much they will get and they know how much they have contributed. The value of the assets does not come into the equation. The income stream can be taken as electricity and the results can be discounts. This reduces the transfer costs even more as less money is transferred. Consumer capital can be thought of as an annuity, asset annuity, and the rate of return determines the annuity return. For a $200 investment, a 5% rate of return means that the investor gets back twice as much value indexed in equal amounts over 20 years. Each year, $10 is the sale of capital and $10 comes from profits. The buyer is the person buying the electricity, who may be several different persons. On the consumer side, independently of what happens on the other side, on the consumer side, the consumer shares the profits by receiving $10 worth of consumer capital sold by the investor. In practice, the actual amount received will depend on the cost of capital compared to the operating costs and the amount of sales compared to the amount invested. The consumer will get consumer capital and the $10 remains invested in the business. With equity, the $10 would invest in the business, but it would belong to the owner of the equity and not be shared with the consumer. The investor is no worse off. The consumer has shared in the profit from the transaction and the capital has transferred from old consumers to new consumers. This has many good social implications as it permits the passing of assets between generations in an orderly fashion and spreads capital more evenly across society. With equity, there is no transfer. With equity, all the capital is accumulated in the business and sold at a later stage, and the owners get the extra capital as capital gains. The delay in transfer delays the value creation. Consumer capital is probably the most efficient capital we can design. There is no interest, dividends or capital gains, no cost of markets to set prices, and we have a continuous transfer of capital available for reinvestment. With equity capital, the capital stays stationary until it is sold and reinvested. It can, while stationary, used as collateral for a loan, but that itself is really expensive. However, in the context of the Australian energy market, consumer capital provides competition to equity. Australians cannot invest in most Australian electricity infrastructure. This is a real risk to national security and leaves the country open to a capital strike for higher returns or worse. If for no other reason, the Australian Energy Regulator should allow Australians to invest in their own electricity infrastructure. So the AER, as a matter of urgency, should set the rate of return at 5% as soon as possible to reduce prices. It should require regulated businesses to replace loans with consumer capital and require all new capital to be raised as consumer capital. Governance. Consumer capital entitles consumers to a voice on the governing board. This will have an effect in productivity because consumers want reduced prices and more profits. The best way to do that is with increased productivity from good investments. Equity capital, on the other hand, wants any investment allowed by the regulator. It's not really interested in productivity or in what they invest in. Big question is, will investors purchase consumer capital? Yes, particularly consumers. A 10% Australian super indexed allocated pension will last for 10 years. Consumer capital indexed returns 10% for 20 years. Plus, if it's the consumer investing, they get a return on every time they purchase electricity. They will flood the market with offers to buy this consumer capital. Is consumer capital fair on existing owners? Well, existing equity owners will get the same regulated rate of return on their invested assets. The current system has been unfair to consumers for the last 20 years. It's not a matter of being fair to the existing equity holders, it's a matter of being fair to the consumers. The Australian Energy Market Commission website says we work for Australia's future productivity and living standards by contributing to a decarbonising, affordable and reliable energy system for consumers. The current system doesn't work for consumers, it works for investors. The economic effects of efficient capital are to reduce the price of electricity and reduce inflation, increase the investment in renewables and funding the rewiring of Australia, and to spread wealth across all consumers and leave no one behind. Changing from equity capital to consumer capital changes many things. One of the things it changes is that it's more efficient for businesses to deal with groups of consumers rather than all consumers as though they were one. Accordingly, the regulator can require consumer capital that accrues to consumers goes to local communities in the form of non-distributive cooperatives with the same aims as the AEMC. Importantly, the cooperatives decides on the split of capital of consumers and how the money is spent. Regulated businesses don't have to wait for the regulator to require consumer capital. They can implement it themselves immediately and voluntarily. The businesses will make more profits if they replace loans with consumer capital, and those increased profits can go to the community. This will kickstart local cooperatives to fund community batteries that are presently not economically viable without government subsidies, but become viable if funded with consumer capital. Consumer capital is more productive, more investment for lower costs than equity investment. The cost of change is minimal and is covered many times over by the gains in capital productivity. Importantly, it achieves AEMC objectives and will help fund distributed networks from the gains in productivity. More information, see me. Thank you.